With most of the AI stocks or the stocks that get grouped into that AI category, most of them are already up 30, 50, maybe even 100% in 2024. But this company, this stock right now is down close to 50% year to date, and for good reason. It was up at one time, actually, it was up at one time 80%. But then, as you can see here, huge decreased dump, should I say, back in late May when they reported their previous quarterly figures. They're going to report their upcoming one on September 5th. Of course, we're going to cover that. The company is called UiPath. Year to date, it's down 48%, has a market cap of $7.39 billion, forward PE 37.7 times, but a little bit more on valuation in just a second. Right now, as you can see, for the fiscal year 2025, which is basically one of the reasons why we're seeing this huge decrease, plus, of course, a new CEO, you see EPS is now estimated to be 30% lower than in fiscal year 2024. Top line growth, this is not even considered a growth stock anymore in my book, because it's growing at 7.6% year over year. Yes, we see a reacceleration in fiscal year 26 and 27, but this was previously a company that was growing quite faster. Actually, if you look at the last 3 years, the stock is down 80%, by the way, 80% since, 2021 or so, the peak of the pandemic bubble. Now, it's true that EPS is expected to accelerate 16% growth in fiscal year 2026, and then another 21% growth in fiscal year 2027. So yes, the bottom line is growing faster than the top line, something that we've seen with plenty of the other companies out there. And so let's discuss UiPath. Let's go over the numbers from last quarter, a little refresh, look at some valuation metrics, and listen to what the analysts were saying after the, let's say, not so good report. I know it's been a while since we've covered this company, since it hasn't moved much since, then, maybe going into the next earnings report, maybe it might be an opportunity to buy before a huge jump, or maybe to avoid it if they report yet another disappointing quarter and the stock goes down. Share your thoughts down in the comment section below, like, subscribe, do all of that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So, for UiPath, the problem has not been really revenue growth over the last couple of years, although, of course, previously it grew faster than today, and free cash flow, it is free cash flow positive, so that's a pretty big positive sign. Unless, of course, in the next coming quarter, free cash flow generation completely disappears. Now, another thing we have to note is that SBC as a percentage of revenue in the last 12 months is still at 27.7%. It's true that it is decreasing, but it's still above that 25%, which is still a bit high. Then if we look at forward PE, EV to EBITDA, price to sales, price to free cash flow, by the way, I'm here on Koifin. Many of you are asking which platform this is. This is Koifin, link is down in the description and in the pinned comment as well. So forward PE 37.7 times, which is lower than their 3-year, 2-year mean or so of 65.1 times. EV to EBITDA 35.1 times, much lower than the 103.3 time 3-year mean or so. Price to sales 5.1 times, so not the cheapest one out there. The margins are quite good, by the way, for this company. Price to free cash flow in the last 12 months, 22.7 times compared to 56.5 times. So, for last quarter, they reported ARR growth rate of 21% year over year, dollar-based net retention rate of 118%, and yes, of course, it is lower than what it was a year or so ago, so this is a number that we're going to have to look at and see, is it lower, and if it's lower, how much lower is it? Then they announced leadership changes. So in a separate release issued today, UiPath announced that the CEO is resigning and member of the UiPath board of directors effective June 1st. Then Daniel Dines, founder and former CEO of UiPath, will be reappointed CEO. So it's not a drastic switch, but it was a sudden change, right? Sudden change of a CEO suddenly stepping down, and then they go back to the founder and former CEO. So, okay, we'll see what happens. Dines is currently serving as Chief Innovation Officer and Executive Chairman of the board. So again, he's very, very familiar with UiPath and the way things are going there. Then as for the comments for the quarter, during the first quarter, we saw increased deal scrutiny and lengthening sales cycle for large multi-year deals. We have considered these factors, the current macroeconomic environment, and our leadership transition in our updated guidance for the remainder of the year. While our revenue and operating margin guidance are impacted by contract timing and duration, we have confidence in our ability to generate durable ARR growth at scale and meaningful non-GAAP adjusted free cash flow. It could be that yet again we have here a software company that has a CEO change and then they just reduce the guidance a little bit to make it easier for him to beat it further down the line. Now, for those that don't know, UiPath does play in a market called RPA, or the robotic processing automation market. It's a market that right now is closer to $3 billion, but is expected to grow to $30 billion by 2030. So that's 39.6% CAGR from 2023 to 2030. Pretty big deal. Of course, these are estimates. These things can change, as we know now with the AI revolution. A lot of things can change. And that's the thing. With AI, generative AI, types of companies like UiPath, if they don't manage it correctly, they can become obsolete. I know you're already saying, oh, but Microsoft Copilot, they work with Microsoft Copilot. The integration there is there. I think they were one of the first ones. So they can exist in this AI, generative AI day and age. They can exist. They just have to execute correctly. And that's the thing. That's what most analysts are waiting for, seeing how the business is doing in this environment. So the current analyst price target sits 17.5% higher than the price we're at today. We've got here a couple of comments. We expect Path shares to be under pressure near term from the sudden CEO departure and as the growth and margin model reset. These developments suggest that the business is in transition and will raise concerns that AI is weakening the company's moat versus strengthening it. Oppenheimer maintained its perform rating on the stock. Meanwhile, KeyBank was quick to downgrade the robotic process automation software company to sector-way from overweight, noting it will have difficulty climbing back to 20% ARR growth levels. Bank of America downgraded the stock to neutral from buy and nearly sliced its price target in half to $16 from $30. And by the way, the average analyst price target after the last earnings report got slashed by around 40% or so. They said here, while some part of the slowdown in multi-year license deal was triggered by a change to the sales incentive structure in Q1 that is already being addressed, we think a further overhaul could be likely. With leadership changes and sale execution challenges, it is likely to be several quarters before the business stabilizes. So most of these analysts are now just sitting on the side. They've all put some negativity towards the stock and the company because they don't like the unknown. And we've seen that before, so I can understand that. So now it's up to the company and management to prove them wrong. Continuing here on the last quarter's performance. So revenue came in at $335 million, growing 16% year over year. ARR $1.5 billion, as we've seen. Non-GAAP operating income of $50 million and non-GAAP operating margin of 15%. Overall, GAAP gross margin still sits at 83%. Yes, it is down from 85%, but still quite respectable. GAAP operating loss is a bit worse, $49.5 million compared to $46.4 million. GAAP net cash provided by operating activities, $100 million compared to $67.3 million. As for guidance for Q2, so for the upcoming earnings report, revenue between $300 and $305 million. ARR between 1.54 and 1.548, non-GAAP operating income basically break even. As for the fiscal year 2025 guidance, they expect revenue between $1.405 and $1.41 billion, ARR of 1.66 and 1.665, with a non-GAAP operating income of around $145 million. And so right now, looking at the graph, since the highs of this year back in February, the stock is now down 53%. Let that sink in, 53% in the last 6 months or so. Now, the stock did rebound in the same area it did rebound last time back in October of 2022. That was, of course, the Black Monday, August 5th. It went back under $11 or so. We've seen a rebound since then. We're now basically at the 20-day moving average or just over it, which is at $12.70. The 200-day one sits at $16.58. RSI is low but not oversold anymore, as we've seen here back in June. So yeah, remains to be seen what happens. We are now in a crucial area. Of course, the earnings report will definitely make this stock either jump all the way back up or crash all the way down depending on the results, plus depending on guidance. Does the new CEO, the founder, actually see some improvements in the deals, in those cycles, yes or no? Because it could be that it is company specific. We've seen other software companies, AI companies in that category, right, report quite good numbers, good guidance as well. So it remains to be seen. Again, this is a company that you could be buying right now and it works out perfectly. But I would say that buying right now would be a risk. Is it a risk that you want to take? It's probably a gamble. It's an earnings gamble. You can make quite a lot from it, buy options, whatever. You can make quite a lot just because of that volatility, those expectations, or you can lose. Me personally, I'm not touching this. Even from an earnings gamble perspective, I think there's just too much unknown surrounding UiPath, and this stock can go up, 100% can go up, but I don't know. Still too early to say. Maybe next quarter, after we've gotten more information in the next coming weeks, maybe the quarter after that could be worth our while if the stock has not moved too much. Remains to be seen. I think this is an acquisition target. If M&As are a thing again, maybe in the next coming months, maybe next year or so, I think this could be an acquisition target. That's just my opinion, of course. Do leave yours down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye-bye.